Hi Rabbits, Research Turtle here. The question we are starting with today is one you've probably heard for the last 17 years. Is it too late? Here we are in January 2026. Bitcoin is trading around $88,000, roughly 30% down from its all-time high. The market sentiment is gripped by extreme fear, with the index hovering between 24 and 29. But, as we will explore today, for a long-term investor, this fear is not a signal to exit, it is an invitation. To understand this opportunity, we must shift our perspective. We are not looking at a trade for next week, we are looking at an architecture for the next 30 years, ending in 2056. This long-term journey requires us to answer three fundamental questions about the asset. First, sustainability. Can it truly endure as a store of value? Second, survivability. Can the network withstand existential tech threats? And third, sovereignty. How do regulations, especially here in Korea, impact our real returns? Let's look at who is in the market with us. 2025 was a watershed moment, the year Wall Street truly arrived. We are seeing giants like BlackRock, Fidelity, and Franklin Templeton not just dipping their toes in, but diving in. This inflow of capital from pension funds and sovereign wealth funds is different. It's not speculative hot money, it is structural, foundational capital that establishes a new floor for the market price. This institutional shift is changing how Bitcoin behaves. Historically, Bitcoin moved in lockstep with tech stocks, but look at the data for 2026. The correlation with the S&P 500 is dropping, while the correlation with gold is rising. Bitcoin is declaring its independence. It is evolving into a truly uncorrelated asset, serving as a hedge against macroeconomic shocks rather than just another risk asset. Now let's talk about the elephant in the room, volatility. In a 30-year journey, we will face multiple drawdowns of 70% or more. But with a dollar-cost averaging strategy, volatility isn't a risk, it's your engine. When prices crash, your fixed investment buys more sats, systematically lowering your average cost. Simulations show that even with the massive 64% drop we saw in 2022, consistent DCA investors outperformed the broader market. That brings us back to today's sentiment. With the Fear and Greed Index at 29 and the Altcoin Season Index at 23, the public is scared. History tells us that capital accumulated during these periods of extreme fear generates the massive asymmetric returns of the next cycle. For a 30-year strategist, this chart isn't scary. It's the strongest buy signal you will ever see. So, where are we heading? Global institutions have modeled Bitcoin's future not as a token, but as a component of the global financial system. VanEck's base case projects a price of $2.9 million per coin by 2050. Even the bear case sits at $650,000. We are talking about a potential 32x return from today's prices. There is virtually no other asset class offering this kind of upside over the next 3 decades. However, we must be realistic about risks. The biggest technological fear is Q-Day, the arrival of quantum computers that could break Bitcoin's encryption. Experts estimate this threat could materialize in the 2030s or 40s. But Bitcoin is not static. The network can upgrade to quantum-resistant algorithms like Lampert signatures via soft forks. As the network's value grows, the incentive to defend it becomes stronger than the incentive to attack it. Another structural challenge is the declining block reward. By 2056, miners will rely almost entirely on transaction fees. Can fees alone secure the network? The solution lies in the growth of the Layer 2 ecosystem. VanEck predicts this L2 market could reach $7.6 trillion, generating the fees necessary to subsidize the mainnet's security budget. You might hear critics say Bitcoin doesn't change enough, that it is ossified. For a 30-year store of value, this resistance to change is its greatest strength. You don't want your monetary policy to be a tech startup that moves fast and breaks things. You want the rules of 2026 to be the rules of 2056. Predictability is paramount. For those of us investing from Korea, the next 12 months are critical. With the deferral of the virtual asset tax to 2027, the year 2026 is a tax-free accumulation window. Any profit you realize or capital you build this year is yours to keep 100%. This is our golden time to build a position with maximum efficiency before taxation begins on January 1, 2027. But accumulating is half the battle. You must secure it. With the travel rule now tightening to cover transfers as small as $680, under 1 million won, exchange policies can change overnight. For a 30-year strategy, self-custody is not an option. It is essential. You need to move your assets to a cold wallet like a ledger now, while you can navigate the whitelisting process easily. When we compare Bitcoin to S&P 500 and gold over a 30-year horizon, the distinction is clear. Gold offers stability but low growth. The S&P 500 offers growth but is tied to the economy. Bitcoin offers absolute scarcity with a projected CAGR of over 7 to 12%. By 2050, it is projected to evolve from a digital asset into a global reserve asset. To wrap up, here is your blueprint for the next 30 years. Automate, remove emotion. DCA mechanically. Secure, adopt not your keys, not your coins as a rule. Use cold storage. Monitor, watch the 2027 tax changes to optimize your exit strategy. Learn, stay educated on risks like quantum computing to manage your anxiety. So, is it too late? The answer is no. The real question is, are you prepared? Bitcoin presents the most powerful asymmetric opportunity in modern history. When you look back from 2056, you won't remember the fear of 2026. You will remember it as the starting point of a great journey. That's it for today. Turtle out.